You hold 10 short option positions across 10 different tickers, standard 16 delta puts. You believe you are diversified. This is the assumption that destroys retail options portfolios, and it is documented in 72 years of market data. A landmark study by Preis and colleagues, published in 2012, analyzed 7 decades of daily closing prices for the Dow Jones Industrial Average. Their finding was direct. The average correlation among stocks scales linearly with market stress. The diversification effect, which should protect a portfolio, melts away in times of market losses, just when it would most urgently be needed. NEO and T in 2023 quantified the magnitude of the shift. During normal markets, the average correlation of stocks to the S&P 500 sits at 40.95%. During tail risk events, that correlation spikes to 64.95%. Your portfolio behaves like a different portfolio depending on what the market is doing that day. And the breakdown is asymmetric. Packham and Wöbeking in 2021 established the pattern. Correlations increase much more in crashes than in rallies. There is a structural reason for this. Brunnermeier and Pedersen in 2009 explained the mechanism. When a market shock hits, distressed traders face margin calls. They are forced to fire sell assets. That drains market liquidity. Other participants are then forced to liquidate unrelated positions just to raise cash. This synchronized forced selling drives the correlation of fundamentally unrelated assets toward 1.0. Rallies do not produce this synchronized urgency. Here is what this means for a retail premium seller. Your 10 supposedly independent positions, structured at standard delta levels across different tickers, are not independent at all under stress. They suffer from sector concentration. When correlations approach 1, the illusion of diversification vanishes. The clustering transforms into simultaneous testing of the majority of portfolio positions. And because these are short options, simultaneous testing triggers nonlinear loss acceleration through delta expansion and gamma convexity effects. History documents the consequences. JP Morgan's London whale loss, $6.2 billion, directly attributed to the sudden decorrelation of credit derivative positions that were structurally designed to hedge each other. The COVID crash of March 2020, the S&P 500 fell 12.5% in a single day. Cross-asset correlations spiked simultaneously. Portfolios relying on historically low correlations between asset classes were wiped out because the historical data did not hold under stress. Institutional risk desks do not rely on static correlation matrices. They use Meucci's effective number of bets, an entropy-based measure that calculates how many truly uncorrelated positions exist in a portfolio. A retail trader holding 12 tickers might have an effective number of bets of 3.8, 12 positions, 3.8 independent risks. They monitor correlation regime shifts using Mahalanobis Distance, measuring how far current correlations sit from historical worst-case scenarios. Clearinghouses model these dynamics, targeting a failure rate of strictly less than 5%. And the paradox most retail traders never see: adding more positions can increase your structural risk. Lhabitant warned in 2011 that adding assets with low mathematical correlation but shared downward exposure does not diversify. It simply accumulates different vehicles that will all lose money simultaneously. Bhansali and Harris documented this directly in short volatility strategies. All short premium strategies are structurally similar. When a volatility shock occurs, each strategy responds in the same direction. The response of the whole is larger than the sum of the parts. Selling more premium across more tickers does not reduce your risk. It scales your exposure to the same tail event. Your broker shows you positions one at a time, independent of each other, because brokerage systems were built for executing trades, not for monitoring portfolio risk. Institutional risk desks see correlation in real time, stress-tested across every position.
We built PortfolioShield because retail deserves the same view. Run a free health check at portfolioshield.app. See your portfolio's true correlation, not the one your broker shows you. 5 more invisible risks coming. PortfolioShield, the risk desk retail never had.